For more on the U.S. economy, let's bring in Anthony Chan, former chief economist at JPMorgan Chase. Anthony, always good to have you on the show. First, I wanted to ask you about your key takeaways from today's decision and statement. What stood out to you?
I think what really stood out is the full understanding that the labor market problems that we're having now are a function of childcare. That probably goes away as more people receive funds to be able to put their kids in child care facilities. The enhanced unemployment benefits that are creating somewhat of a disincentive to go and take a job. That, of course, expires on September 6th. And, of course, the health concerns of many, that is going to linger a bit. But the more people receive these vaccinations and the more we get through this Delta variant, that also goes away. So you have right now about 6.7 million people, when you look at non-farm payrolls, that are not working today that were working before the pandemic, and a little over 7 million if you're looking at the household survey employed. So all those people, or many of them, could come back if these issues go away. And certainly Jerome Powell talked about these things.
It's hard to tell what direction this country is heading if you look at the Delta variant and its impact in other parts of the world. Do you think the Fed is taking into consideration where we might be in the fall, for example, in its projections?
Oh, I think they are watching it. As Fed Chair Powell said, he's not a medical expert out there, but one of the things that he is noticing is that economic activity is not being hurt as much in this wave of the pandemic. And part of that is because there are more people that are vaccinated. And part of it is because we have better tools to deal with the pandemic. So yes, it will have a negative impact. And if anything, if it has a slight negative impact, then all these concerns about overheating of the economy, that may kind of cool off the economy just slightly. Not that we want the economy to cool off because of a virus, but it may very well have that impact and reduce some of these inflationary pressures.
Yeah, I mean, that's one of the concerns that some people have, that the pendulum may end up swinging completely in the other direction. How concerned should Americans be about potential inflation?
Well, I think you have to be concerned because inflation is clearly growing at a very fast pace. But again, if you listen to what the Federal Reserve was saying today, is that they believe that inflation is going to slow down a little bit, perhaps in the next 4 to 6 months. So I think it's too early to say that this inflation issue is serious, that we have to panic, because again, you're looking at inflation in many of the reopening areas, airline tickets, used car prices, those kinds of things, rental car prices. Those are commodities or services that are related to the reopening. And to the extent that we get through this over the next couple of months, we may see some of these inflationary pressures ease. Of course, the Federal Reserve said they're standing by and ready to use their tools if somehow this inflation turns out to be more serious and less transitory in nature.
I want to talk to you a bit about the housing market. We've been talking about these numbers all week. The price of homes, new homes, significantly going up in some cities like Phoenix, 21% higher than before. In June, for the first time, new house sales down significantly, perhaps suggesting that many Americans simply can't afford these new prices. What are your projections for the housing market going forward?
I think housing will continue to be strong. Obviously, these price increases are unsustainable because if you look at wages, the wages are not rising by anywhere near the type of increases. But again, why are housing prices rising? Again, a big rush out there to buy these houses. Mortgage rates are at very low levels. When you start to see the Federal Reserve tapering, and we should hear an announcement before the end of the year, interest rates will start to pick up a little bit. That may cool off the housing market to some extent. And we will see that the increases in housing prices that we're seeing right now will, in fact, ease a little bit as you go into next year. And that is something that is going to be welcome news for the housing market because it's going to make it more sustainable and less bubble-like in nature.
And finally, a Q2 GDP report coming out on Thursday morning. Briefly, your outlook for that.
I'm looking for real GDP to be up somewhere Around 7.25%, which I think is a very strong number, but again, not a surprising number given all the data that we've seen. We did see some trade numbers today that suggest that maybe you've got to shave off a tenth or two off that second quarter GDP, but it's still going to be strong, much greater than 7%, which again is a very strong number considering that potential growth is somewhere in the 2% range.
Anthony Chan, as always, thank you for your insight.
My pleasure.